Hello, this is Japanese Economic Review Channel. Today we discuss Japan Inc. 2026, the transition economy, based on the June 2026 BOJ Tankan survey. Surveying over 9,100 enterprises, we see Japanese corporations navigating a critical phase. We will explore how firms are shifting from demand-constrained to supply-constrained environments, utilizing strategic investments to overcome severe labor shortages and margin pressures. The current landscape features three main themes. First, business sentiment remains stable at +1.8 DI. Second, despite top-line growth, companies face a severe margin squeeze, forecasting a 6.5% profit contraction. Finally, structural shifts drive robust capital expenditures of +8.8%, even as a severe labor shortage of -37 DI establishes a permanent ceiling on domestic capacity. A key baseline for 2026 is a normalized, weaker yen. Companies anchor their business plans on assumed exchange rates of 152 yen and 57 sen per USD and 175 yen and 62 sen per euro. This weak yen environment bolsters export revenues for manufacturers, acting as a defensive moat, while simultaneously locking in high imported input costs that squeeze domestic margins across all sectors. While overall sentiment stays stable at +1.8 DI, a scale premium reveals a stark reality gap. Large non-manufacturers lead the economy at +3.7 DI, whereas SME manufacturers trail significantly at +9 DI. This 28-point gap illustrates that large enterprises are successfully absorbing macroeconomic friction, while SMEs struggle to navigate the transition. Input cost inflation relentlessly outpaces pricing power. Large enterprises face an input price DI of +6.2, but an output DI of +4.0, a 22-point deficit. SMEs are hit harder. They share the same +4.0 output DI but face a massive +7.6 input DI. This 36-point deficit means SMEs are absorbing vastly higher supply chain cost shocks without the ability to fully pass them on. Despite projected sales growth of 2.5% across all industries, rising operational costs erode these top-line gains. Consequently, every major sector anticipates a profit contraction in 2026, averaging 6.5%. SME manufacturers expect the deepest drop at -11.1%. Volume expansion alone is failing to protect margins, highlighting the urgent need for strategic pricing adjustments. Our diagnostic matrix contrasts the resilience of large enterprises against SMEs. Despite a managed profit contraction of 6.5%, large firms retain capital flexibility to expand investments by 10.7%. Conversely, SMEs, suffering deep profit contractions, are forced to shrink capital expenditures by 1.8%. Only large enterprises are truly investing through the dip. Total planned CapEx is a robust +8.8%, yet its composition is evolving. Investment is increasingly intangible, targeting software and R&D. Large non-manufacturers drive this with a 14.4% increase, investing heavily in digital transformation and automation to combat capacity constraints. This marks a strategic pivot toward next-generation growth engines. Japan's economy is now acutely supply-constrained. The employment DI is deep in negative territory, hitting -37 for all industries and projected to reach -40 by September. This shortage establishes a permanent, structural ceiling on domestic growth. Companies must aggressively deploy automation or expand overseas to bypass these domestic labor constraints. On the financial front, liquidity remains available, with the lending attitude DI at a comfortable +1.3. However, the BOJ's policy pivot has rippled through corporate expectations. The borrowing rate expectation DI has surged to +6.1. While capital is accessible, it is becoming more expensive, signaling the definitive end of the era of zero-cost corporate leverage. Facing severe domestic constraints, Japanese manufacturers increasingly rely on global markets. In 2026, they plan to generate 61% of their sales overseas and direct 32% of their CapEx to foreign operations. Protected by the weak yen, these global operations serve as the primary defensive moat and growth driver for Japan's industrial base. In conclusion, Japan Inc. is under intense pressure but is not in recession. The winners in 2026 will be those, primarily large enterprises, capable of deploying capital into automation and overseas markets to bypass domestic labor shortages and pricing constraints. Thank you for your attention to this executive macroeconomic briefing. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.